Hi, welcome to Your Finance TV's first show of the year. We are here with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back.
Hey, great to be here, Mehdi. Happy New Year to you.
Happy New Year to you, sir. So 2023 is behind us, and what a year it was. And Jeff, obviously, you published your monthly review and outlook, which is available on Substack at hugeinsights.substack.com. But a little bit of housekeeping. We've blown through 10,000 subscribers, and we appreciate all of your support. So please feel free to like and subscribe to Your Finance TV to stay on top of all of our content. So, Jeff, let's kick off 2024 with our usual top down.
Yeah, just a year in review. 2023 was one of those years where you either owned the Magnificent Seven and held on for dear life, or you didn't. And if you did, well, congratulations. You had a great year. The S&P was up 26.3%. Nasdaq was up 55%, and it owes most of that to those seven stocks. In fact, if you look at the average return of a stock in the S&P 500, it was up about 11.5%. The median performance of a stock in the S&P 500 was up 12.6%. These are pretty pedestrian returns. So outside of the Mag 7, you really kind of had kind of an average year, right? From micro cap to mid cap, everything was up somewhere between 10 and 14%. That kind of range that I described. And so, the real question is, where do we go from here? And our thinking at this point is that when we look at the S&P 500, the construct of the index, this over concentration in these heavyweight tech stocks, we do not think we're going to see a repeat of what we just witnessed in 2023. So I think over concentration risk is probably the biggest thing investors need to focus on. And, from that perspective, a lot of people are saying, well, hey, look, the market's really broadened out, Jeff. Look at the Russell 2000. Look at the average stocks performance in the last 2 months. Yeah, we had a face ripper the last 2 months, no question. And the reason we had that is because, market sentiment got to an extreme fear level, right? An extreme bearish perspective. And so, when everybody has moved to one side of the boat, you could expect the opposite to happen. The problem is today, the exact opposite extreme exists. In fact, the name exposure index is now leveraged. So professional investors are all in, Mehdi, and it's actually exceeded slightly the peaks that we saw in July of last year. And so, that has us saying, it's unlikely we're going to see this move tremendously higher. And even if we did see a marginal new high out of the S&P 500, it's our view that we're putting in a double top. And we've got a couple of different perspectives that we look at technically. Most importantly, through our lens of Elliott wave analysis. And there's two counts that we're focused on right now. And even the bullish count does not imply much upside from here. But when we look at the broad market, the Russell 2000, the value line geometric, these indexes are nowhere near hitting their all-time highs. In fact, it's just these narrow indexes. The Dow Industrials made a marginal new high. Well, Apple and Microsoft and, some of the bigger, healthcare, United Healthcare, for example, a big liquid name that a lot of people have been hiding in because it's not very cyclical, right? The NASDAQ 100, as we said before, the Mag 7 concentration is 60% of the NASDAQ 100. So there's no question that these narrow indexes are hitting new highs because of that reason, where the broad indexes are nowhere near. And I think they're very stretched at this point, and they look like they've put in classic corrective waveforms that are likely topping or very near topping now. And so, our view is that the market has much more downside risk in 2024 than upside risk at this point. And one of the big fundamental reasons that continues to support that is all of the indicators pointing to recession in 2024. I know we said this in 2023. I know that we've been wrong about the market. We've been wrong about the recession coming, but that doesn't mean it's not going to come in the future, right? Just because it's been pushed out. I think the soft landing narrative is wrong. And I think that if the Fed does cut aggressively, it's going to be because of a crisis, because of a recession. And I think that recession is likely to occur in the first half of 2024.
All right, so thank you for that recap, Jeff, and kind of rolls me into my first kind of question quite nicely with the recession thoughts. So we've obviously kicked off 2024. Market seems to be pricing in rate cuts, or it was, especially going into the end of last year. The Fed's still maintaining the data dependency narrative. Has inflation eased enough to imply rate cuts are imminent, or not really in your sort of what you're seeing?
I would say not yet. Okay, so there's no question that we've seen a dramatic reversal from the all-time record, or I should say, the all-time highs of a couple of years ago when we got up to around 9% on the headline CPI number. But what we've seen since is the compression of inflation has simply gotten back to a level that's now about double where the Fed has inflation targeted. And why do I say double? Everybody talks about the core PCE. That's at 3.2. That's not double 2%, is it? Well, no. But if we look at the inflation dashboard that's put out by the Atlanta Fed, this takes a look at all of the Fed's key core inflation models. Right? There's 9 of them. All of the 9, regional Federal Reserve banks have their own sort of approach to calculating, core inflation. And even though the street and to some extent even the Fed has stated core PCE is kind of the one they're really focused on, they're focused on all of them to some extent. And if we look at the aggregation of these, we're now looking at core inflation coming in just above 400 basis points right now, or 4% annualized. The Fed's target's 2%. So we're about double where the Fed is targeting. And if you look to the right on this chart, you can see the levels that each one of these models should be at, okay, if we're going to be at 2% core inflation. Well, unfortunately, if you look back to the left now, you can see that none of them are anywhere near that level. And so there's a lot of wood to chop here. And I just don't think we're going to get there. It is short of order as the street is factoring in right now with, in some circles still looking for the first rate cut in March. By my measures, if we got a rate cut in March, it would not be because inflation is improving. It would be because the Fed is panicking because the economy is spiraling into recession. And I think the first evidence of that will come when we see fourth quarter earnings reported. That's coming up in a couple of weeks here. And, it's our opinion that estimates are going to be, it's our opinion that actual results are going to fall short of estimates and guidance is going to fall well short of expectations for 2024. And so that to us is going to be the first indication that the economy is already losing a lot of steam. And the Fed may react to that in March. It's hard to know what they're going to do, but it's not going to be because the inflation data has improved enough.
So, Jeff, while we're in this higher rate environment, are we seeing or starting to see evidence of a credit crunch?
Yeah, there's no question. Bank credit is contracting. It's negative right now across all commercial banks in the United States. But if we look at the last SLOOS report, this is the quarterly senior loan officer survey. More than 1/3 of the senior loan officers are suggesting that credit will continue to tighten, that lending standards are becoming tighter, and credit availability is becoming tighter. And that's typically been, the case when, we've seen this sort of level of concern and tightening going into a recession. So, we actually got above 50%, and now we've turned back down. And so usually it peaks around, slightly above 50% or so, and then we see a rollover. And then the Fed starts to take action in the subsequent year, and that loosens standards. But right now they are tight, and most, or I shouldn't say most, but more than 1/3 of senior loan officers do believe that condition will perpetuate throughout 2024. So that to me suggests a big economic growth concern because it's credit that fuels economic growth.
So, you've obviously mentioned recession multiple times so far. And the economic indicator dashboard seems to have been quite a good indicator for you. Has there been any marked change in this?
It's become less significant, or I should say, less contractive. Okay, so the word I'm looking for. Let me just set the Wayback Machine to 16 months ago. 16 months ago, the LEI index saw its 6-month rate of change break below -4% for 2 months in a row. All right. When that has happened in the past, going back to the entire history of the data since 1970, within the next 6 to 18 months, a recession has ensued. Okay. Every single time, it's a 100% track record, hit rate, if you will. Our position is that now that we are 16 months into it, that's 2 months shy of 18 months, the longest it's taken in the past. Our suspicion is that before the next 2 months are up, we will be in recession. We might not know it. The TV media may not announce it, but when the NBER goes back and suggests when did the recession start, we think it will have started within those 2 months or earlier. And so, the bottom line is the LEI index is a pretty good indicator of future recessions. And what it's telling us today is that a recession is likely to unfold, a full-on recession is likely to unfold within the next couple of months.
So, Jeff, in your opening statement, you touched on this as well. But before we dive into the technical side of things, can you run us through your thoughts on the bull market of 2023?
Yeah, like I said, it's far less epic than meets the eye, and the easiest way to see that is to take a look at the return of the average stock. We look at the equal weight S&P 500 as a pretty good proxy for that, and you can see that the equal weight S&P 500 was up just 11.5%. Nothing to be particularly excited about. That's around the average stock return of the last 50 years. If we take a look at the median return was only slightly above that, meaning that half were better, half were worse, right? I think what's really significant is that 70% of the constituents of the S&P 500 underperformed the benchmark's return for the year, and a full 1/3 of those constituents closed out the year in negative territory. You don't really see that in a raging bull market. So, despite what the headline index returns are, the underlying performance of the constituents in the index has been far less epic, and that the bull market itself has been extremely narrow. And I think that the narrowness of these returns over the course of the year, not the last 2 months where we've seen quite a broadening out, no question of that. But I think that's run its course. And by the way, we saw the market attempt to broaden out on 3 separate occasions, only to completely reverse those broadenings and make new lows in the subsequent months. And I think that we're getting very close to a point where that's likely to unfold again. So we are not particularly optimistic about the headline returns that we saw in the S&P 500. And we think it's unlikely that the conditions that supported those returns are going to materialize in 2024.
Jeff, let's talk technicals. I see here you've got 2 cases. You've got the bullish and the bearish case. Can you run us through your thoughts here and some of the levels that jump out?
Absolutely. So, we've had a preferred count that suggests that the initial decline off the Jan 2022 high into the October 2022 low was initially a corrective waveform, or part of a corrective waveform. We originally began counting it down as a 1, 2, 3, 4, 5, an impulse wave. It was a sketchy impulse wave. It met the basic definitions of a leading expanding diagonal. That may still be true. From that low, we count a double zigzag. WXY is the count on that. We believe that that is probably wave 2 or B within a corrective waveform that's unfolding right now. What we might see is we might see wave 3 down begin today, right? As we cross over into the 2024 realm, there's going to be a lot of profit taking. A lot of people who wanted to lock in profits from last year but didn't want to pay taxes within the next 4 months, wanted to push that out a year. And so by waiting till January 2nd to sell, they're pushing their tax consequence out 16 months, basically, instead of 4 months. And so I think that is going to be a pervasive problem during the month of January. Some overwhelming profit taking. One of the things that would then likely be important is to see whether or not 4,600 on the S&P holds. If that holds, then we're probably looking at the bullish alternate case. Okay, bullish alternate case would suggest that no, that initial decline was not wave A or wave 1 in a corrective waveform, but it was the entirety of the corrective waveform. And that corrective waveform was probably a fourth wave at perhaps primary degree of trend. And so we've adjusted our count to suggest that, and we can make it fit. We force it, but we can make it fit. And we can argue that the advance off the January or the October 22 low is an impulse wave, and it very narrowly meets those rules and guidelines from Elliott. And so if in fact it does carry to a new all-time high, which would be necessary for this to be the case, then we could project an upside target to around 49.40. To get there, 49.40 would mean that primary wave 5 is 2.618 times primary wave 1. And if that plays out, then we should see the market top within about 150 points of where we closed out at the end of the year, right? A marginal new high. That would end what we believe will be cycle wave 5 and super cycle wave 3. So that's the bull case. Bull case is we got another 150 points to the upside. The bear case is that we've begun wave 3 or wave C down right now. The problem with the bull case is once we reach that peak, that 49.40 level, we expect a major super cycle bear market to begin. And so it's just a matter of semantics, Mehdi. Both of these scenarios point to a double top in the S&P 500. One suggests that the second top is going to fall, marginally short of its January 22 high. The other suggests that it's going to be a marginal new high. In either case, we expect a double top, and we expect 2024 to be a significant down year.
So ultimately, all roads lead to the same place.
I think so, yeah.
So, but then let's have a look at the long-term trend following model, because this looks positive, right?
It does. And, trend following models are basically, driven by moving averages, right? And so moving averages are a function of price. If price changes, the moving average is going to change. And so, the breakout that we saw, this face-ripping rally that we saw over the last couple of months has really turned up these longer-term moving averages. And the longer-term moving average crossover signaled a new positive trend following model, right? And so we are now in positive territory on the trend following model. But if in fact we were to see price action reverse and over the course of, say, the next 2 months do the exact opposite of what we saw in November, December, we could easily see this trend following model see another crossover to the downside, a negative turn. And so, we're looking at a couple of different versions of it. We look at it both on an equal weight basis and a cap weight basis. The cap weight basis, I think, has more risk than the equal weight basis, but I think they will both turn down eventually.
So has investor sentiment changed at this point?
Yeah, like I said at the outset, I think we've moved to the polar opposite extreme from where we were on October 27th. Mehdi, back on late October, we saw a level of fear that was consistent with what we saw in October of 2022. The vast majority of investors expected the bottom to fall out of the market. We had broken trend. We had broken moving averages. The Elliott wave count looked very, very bearish at that point. And I think a lot of investors were really, really frightened. And that showed up in a number of metrics. The AAII got down to negative 42%, negative 24% rather. The name exposure index got down there as well. And so, we saw these major constituents, these major cohorts of investors, be it professional investors or individual investors, bail out of the market at that point. And it reached an extreme. Where are we today? The exact opposite position. In fact, the name exposure index has taken out the highs of July last year. We are now at 102% net equity exposure. That's a leveraged condition. It's rare when the professional investing community levers up. And when they do, it means that they are absolutely, positively confident that the market is going higher. They're all in at that point. The individual investor survey actually peaked last week at 32%. That was the highest that we've seen in 3 years, and it held there for 2 consecutive weeks. This most recent week, it actually turned down. And so we saw a rather marked reversal. Well, it's not uncommon for these measures of sentiment to peak and roll over. When they peak, they peak. Prices usually top at or about the same time, and then they decline in tandem with these sentiment measures. And when the sentiment measures reach extreme levels on the opposite side, then we've probably seen the majority of the decline for that leg of the decline. And so where I think we are right now is we're rolling over from a top. And that's why I continue to have the bear case as our preferred Elliott wave count, because it's so closely synced up with sentiment at this point.
So onto some macro assets. And you obviously, this is your big monthly piece. You examine a lot more than what we're going to touch on here. But, historically, gold, the shining stuff, has been a decent flight to safety for many investors. So it's had a nice run, though, so far. What are your thoughts here on the future of gold?
Well, we're exceptionally bullish on gold, and I'd go right out and tell you that's our top actionable idea for 2024. Gold did something that we hadn't seen in a very, very long time, and that is it posted 2 consecutive new monthly closing highs in November and December. And those monthly closing highs really suggest to me that gold is breaking out of a long-term base formation that began back in 2011. And if you look at a chart of gold, you can see a very large degree cup and handle-like pattern, whereby the handle itself is breaking out to the upside. And that formation counts a move to around 2,500 in gold. But if we look at the broader picture, the bigger picture, we can actually see a much higher target price. So we raised our target on gold to 2,800. Now, it's not like a 12-month target necessarily, but it's our target of where we think prices can go for gold over time. So we're not necessarily looking for 2,800 before year-end 2024, but eventually we think we'll get there. And from where we are today, that's a significant upside, about a 30 to 33% upside potential for gold if it reaches our target.
Understood. And another hot topic in the macro world, but less so on the performance side, is the US dollar. What are your thoughts here on the US dollar?
Yeah, a lot of people think that gold and the US dollar have to move inversely. They don't. There have been many, many periods of time where both gold and the dollar advanced in tandem or contracted in tandem. And so, we think that the dollar has further upside as well. And one of the reasons we think they'll both move up together is because they're both safe haven assets. And we think as money moves out of risk, it'll move into US dollars, it'll move into cash, it'll move into hard money, which is gold. Gold is the ultimate hard money. And I think both of these asset classes will catch a bid if we're correct about where the stock market is headed in 2024.
Fantastic. So, Jeff, before we wrap here, obviously you have your top actionable trade ideas, which are available to subscribers. But, from a higher level picture, can you give us a few thoughts on the sectors of choice?
Sure. It's absolutely clear to everybody who's been observing the market for the last 12 months where the leadership is. It's technology, it's comm, it's discretionary. Those three sectors have been the leaders over the last 12 months. The big losers have been healthcare, utilities, energy, and staples. Right. Because of our view on the economy, and because we think it's going to be a global recession, I think energy could continue to be problematic. And so, even though it's cheap, and even though we like a lot of stocks in the energy sector from a bottom-up perspective, I think energy could broadly be a problematic area for 2024. That being said, I think there will be a rotation out of tech, out of comm, and out of discretionary and into safe havens, such as healthcare, which is actually seeing the strongest upside earnings revisions in 2024, into staples and utilities, which are really, really under-owned right now, very, very oversold, and very, very cheap relative to their historical valuation levels. And so, I think we could see money rotate into defensive areas. Another area that has us interested is REITs. REITs have actually done very, very well. They're one of the best performers, actually the best performer in the month of December. But REITs are traditionally an area that has captured safe haven money because of the dividend. We are somewhat concerned about commercial real estate as part of this recessionary situation because, there's a lot of CRE loans that come due in 2024, about $600 billion worth that will need to be refinanced in the next 12 months. And so that could put pressure on some REITs, but we think it's going to be primarily in office and retail. And we think, the broader REIT area is pretty diversified. And we think multifamily continues to look good. We think industrial continues to look good, storage, areas like that. And so, we think selectively REITs could continue to be a strong performer.
Brilliant. Thank you very much for that, Jeff. And thank you for sharing your thoughts from Alpha Insights.
Always a pleasure, Mehdi.
And as always, I want to thank our viewers and make sure you check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, thank you for watching and good luck investing.